Good morning, everybody. Welcome to another edition of Benzinga All Access. I am so excited for this show today. I'll get to why in a second. My name is Spencer Israel. You all know me by now. I'm here at Benzinga, and look, we talk about the stock market a lot, right? It's sexy, it's fun, it's volatile. But there is more to life than stocks, everyone. There is more to life. Yes, even to ETFs. I know, sacrilege, but it's true. There's more to life than equities. That is the purpose of this stream today, this show today. We want to bring to light other assets that maybe you haven't looked at before, you haven't considered, maybe you didn't even know that you could get access to, but you can. There is an entire world of assets out there outside of equities. Let me just show you this chart that I reference quite frequently in my just comings and goings. This is an asset quilt from Novel Investor. Okay. Every color on this quilt is a different asset class. Well, most of them. So we've got large cap stocks, we've got small cap stocks, but we've got REITs, right? We've got bonds, we've got cash, right? There are so much out there. When you think about your portfolio, I'm going to be honest with you for a second. If you only own U.S. stocks, you're not diversified. If you own a tech stock and a food stock and a utility stock, you're not diversified, right? True diversification comes from owning something other than a single asset class, something besides just stocks. I always think about my portfolio from the top down. I think of it like a pie chart. That's literally how I think about it. What do I own? I've got my brokerage account here. I've got my crypto account there. I've got other accounts here and here. And yes, true investors, they invest with an asset allocation mindset. They invest not just all in on one stock or even one group of stocks. They invest by allocating to different groups, different assets, be it stocks, be it bonds, be it crypto, be it gold, be it real estate, whatever. And that's the point of today's show. Okay, we're going to talk to you about these other asset classes that historically were only really available to high-end institutional investors, but that is not the case anymore. And it's great that we're having this show today of all days. Let me just show you guys a headline in the Wall Street Journal that was from yesterday. This headline was from yesterday. Let me say that again. SEC panel backs lending ordinary investors into private equity. But if you actually read the article, it was not just private equity, it was also real estate. Okay? There is a movement to open up access to other asset classes, to retail investors. The companies that'll be on today's show are a part of that movement. Who are they? You're asking. Who is on today's show? Well, if you scroll down and look at the description, you would know. But here you go. Crowdstreet arrived, MODIV, Alumni Ventures, 4 companies that are doing what they can to take asset classes that historically, like I said, were really just cut off from the everyday investor and make them available, right? Make it so people like you and me can get access here. So let's start with real estate. Let's start with Crowdstreet. I'm very excited to bring on Chris Pachinger and Brent Hieggelke from Crowdstreet. Let's get those guys on right now. Oh, wait, that's not it. There we go. Brent and Chris, how are we doing?
Good. Great.
Doing great. How's your day going?
Wonderful.
Just bright and early here, West Coast.
Bright and early. I know you guys are on the West Coast. I appreciate you waking up early for us. So I'm excited because, like I said off the top, we spend too much time. I'm as guilty as anyone is talking about the stock market, but there's just so much more to life than stocks. And you guys are at Crowdstreet. First, just tell us about the platform. That can be directed to either of you. Tell us about the platform, how it works, and then we'll get into the fun stuff.
Yeah, I'll start. You really opened up with a lot of great points, and Just before I talk about the platform, actually, I'll let Chris talk about how it works. Let me just hit a few points that you opened up with.
Cool.
The reason why most people haven't thought about this is key to what you said around access. So up until 2012, the reason why you didn't have access to this was because it was basically illegal for real estate developers, we call them sponsors, but real estate developers, to solicit their deals to ordinary people. So unless you were a golfing buddy, unless you belonged to a country club with the right folks, you didn't know about these deals and you didn't have access. So literally it was down to who you knew, what they did. And so if they were a multifamily real estate developer in your market, you were lucky enough to get involved in their deal. And that was it. And that was the landscape. Besides the institutional investors, like you mentioned, the institutional investors have been investing in this for decades. So the billionaires, the pension funds, the endowments, the large institutional endowments, they put 15, 20% into this type of real estate, commercial real estate, institutional quality real estate. And so 2012 legislation changed. The Jobs Act made it legal for these types of offerings to be solicited to investors, accredited investors today, for the most part. And that's the SEC. That's a government sort of regulation of people that have $1 million to invest, roughly, could now start marketing these to ordinary investors. And so that changed, and that's where Crowdstreet came about, was initiated with that legislation change. And we are a marketplace that allows these very successful, long track record real estate developers all across the country to bring their projects to Crowdstreet Marketplace, and then investors can review those, decide what makes sense for them, and invest in those deals. So Chris, why don't you kind of take it from there and give a little more detail on how that works?
Yeah, thanks, Brent. So really what we've done is we've built a two-sided marketplace that sits at the intersection of all of these sponsors, real estate developers that Brent mentioned. So we're really targeting institutional quality real estate developers. So typically groups that have done, if not many hundreds of millions of dollars of transactions, typically billions of dollars of transactions. And then our team and our process, our technology is really fleshing out which of those sponsors have opportunities that make sense for the investors. And we have over 100,000 investors that they're registered members of our platform that will come and evaluate those deals as they come through. And really it ends up being as simple as, we bring deals to the marketplace after our team does a lot of work with those sponsors to understand the opportunity and help them with how they positioned it. And then our investors have the chance to check them out. And typically it's, 10 or 12 deals every month that they have a chance to take a close look at. And really, investing is just hyper simple. You're clicking buttons on the internet, and these are private equity deals that are typically much more difficult to get into, but we've really simplified it.
So who are these sponsors?
So like Chris said, they're firms that we've had firms that are over 100 years old. These are folks with billions of dollars of history. What we do is we like to say that, so we have an investments team that reviews these deals. These are very experienced commercial real estate experts that have joined Crowdstreet. They go through the projects. They interview the real estate developers. They look at their track record. They spend, I don't know what the current estimate is, but it could be up to 100 hours digging into these deals, looking at the market, looking at the projections, looking at the business plan, what's around it. So everything that anybody who would want to understand if an investment made sense, they're doing that, but they're doing it on behalf of the Crowdstreet Marketplace.
Right.
Roughly 5% of the projects that we encounter make it to the marketplace. So it's they go through excruciating detail to figure out if this project makes sense for our marketplace. Now, that doesn't mean it makes sense for every investor. We're always clear. It's like we believe this makes sense for our investor base to look at. Individual investors need to decide, like you're talking about, is this the right diversification strategy? And one of the things that's interesting is we find that people say, hey, I can now be diversified within real estate across the country, across the different asset classes. And so it's pretty interesting that they can dig into that sort of diversification. But these are firms that are developing, $100 million multifamily projects. Sometimes it's $250 million, mixed use, retail, office, multifamily. So they're big projects.
Yeah.
These are, I would say $75 to $200 million in market capitalization. They're not your corner, strip mall. It's institutional quality real estate.
So there's a market cap component to it, but I guess that sort of answers my question, which was what determines whether a deal is appropriate for your marketplace or not. I guess there's the market cap component, but are there other aspects to that?
Yeah, Chris, you want to tackle that?
Yeah, I'll hop in on that. So the team that's evaluating the deals, they're looking at really dozens of different factors. So we could have a whole separate conversation about that, but they're looking at everything from top line, is it an interesting market? So we tend to focus on what we call 18-hour cities. So we want really up and coming, rapidly growing markets. So we're much more likely to be into something that's in Nashville or Raleigh than we are in a really mature and more slowly growing city. So we're looking at factors like that. We're looking at the track record of the sponsor. Do they have experience building these types of assets or refurbishing these types of assets? Do they have a good track record of delivering returns to their investors? And then we're digging into the nitty gritty models they're using to build out their forecasts and their pro forma, all the way down to the deal documents, which are pretty critical for any kind of private equity transaction. So, I could ramble on that for quite a while, but from top to bottom, whether we're talking high level market dynamics down to the nitty gritty details of the deal structure, our team is evaluating that. And as Brent pointed out, this is a team that's really a group that has a lot of depth doing private equity commercial real estate deals. So that this is a team of specialists that's really evaluating, again, whether it's a fit for the marketplace, not necessarily for investor A or B, but for the marketplace overall.
So Brent sort of spoke about this off the top, but I want to zoom out if I can for a moment and talk not so much about Crowdstreet, but just about the sandbox in which you play, private equity, commercial real estate. Just can you tell us more about this asset class? And I know you guys can't talk like specific like returns, but like you have return profiles, I'm sure that you can share, and just in terms of just how the excuse me, how the asset class is structured, who are the major players, and just things investors should know if they're getting into it.
Yeah, I think, well, off the top, commercial real estate is the third largest asset class in the world, right? So there's stocks, bonds, and commercial real estate. So it is kind of unbelievable that folks, most likely today, most people don't have this in their portfolio when it's right behind those other two asset classes. It's trillions of dollars of value, and about $500 billion of that in the U.S. gets exchanged every year, right? So there's a lot of activity in this sector, but again, it's been sort of sequestered into this private world. And until the Jobs Act came up in 2012, it was passed as legislation. It was just literally kind of hidden off in these private corners. So it's massive. And if you think about it, it's besides your house, it's probably every building you interact with on a daily or weekly basis, right? It's everything from self-storage centers to multifamily to senior living, student housing, retail. It's every other project besides single family homes and second homes in real estate. And so it's just this giant world of fascinating projects. I mean, it's really amazing to see. So we actually had somebody on our executive team just come back from Nashville, and they stayed at the Virgin Nashville Hotel, which is this beautiful downtown Nashville hotel, Virgin branded, rooftop pool. And she said, it's so amazing to see these projects now that we funded a couple of years ago now, living their best lives. And so those are the kind of projects we're talking about. And it's something that, like I said, most folks haven't thought about, like, how do I put my money in this? How do I get access to it? But now that it's happening, our investors are incredibly excited And, we have people building $1 million portfolios on our platform, like
Wow.
routinely now. I mean, it's practical, it's astonishing. And look, for us, we're a marketplace, right? So we're literally bringing these projects to the marketplace, and investors evaluate them. So, we're sitting in the middle, just making that connection and that opportunity. But it's investors are delighted to see these kinds of projects at their fingertips. As Chris said, they're building an online portfolio just like you build, trade stocks.
Sure.
And so it's really, we're sitting, we think, at this nascent part of this explosion where people are saying, why wouldn't I put 15 to 20% of my portfolio as a great hedge? I got crypto, which is whipsawing 10 to 30% a month. These are the one thing people need to know is these are not liquid investments. These are going to be 3 to 5 years probably on average. I mean, there are deals that do sell in a year. It does happen, but you don't want to think about it that way. You want to think about this as a 3 to 5, 5 to 7 year project. But we do forecast that, or we don't do it, but the deal documents forecast the business plan and the projections. And so far the returns have been, I think most of our investors are pretty happy with them. And we publish all this on our site. So, we publish all of the aggregate returns to date. We publish all the case studies of all the deals that exit. We've had almost 60 deals now exit off the marketplace and sell. So we know exactly what's happened, and we publish all of that so investors can get the confidence they need.
Big thing I want to stress is like, this is not some random new thing, right? This is not some altcoin, and not to take nothing away from DeFi and crypto, but like, this is not a new asset class, is my point. This is a tried and true investment vehicle that, like, Crowdstreet did not invent this. They're not, all they're doing is democratizing it. So I would say to anyone who, if you didn't know about this asset class, don't think of it like any new asset class, because it's not even new per se. It's just maybe new to retail. But this is not just some thing that they threw together, and trying to sucker investors in. This is a real thing. This is a real asset class that is tried and true. Brent, you sort of teased it there a little bit, but I'm just curious how you see the investors in your marketplace allocating to CrowdStreet. I think you gave a 15 to 20% range there. I'm sure everyone is different, but is there a typical, in your surveys and your marketing, is there a typical allocation range you see, or a size of portfolio maybe that you see amongst your users?
Yeah, Chris actually spends a lot more time on our segmentation, so I'll let him tackle that, what he's seen.
Yeah, I mean, it's a good question, and it's really variable. So this is playing a different role in different people's portfolios based on where they're coming from. So we have investors that have gone, everywhere from 25, 30% of their portfolio in commercial real estate and CrowdStreet, because one of the big things we're doing, as you pointed out, Spencer, is we're bringing access to the table to something that's already existed. So they'll use us to get into those deals. And then we'll have people that are just dipping in a toe for the first time, and they've got 2% of their portfolio in CrowdStreet. If you really wanted to pin me down, I think that the typical user is probably in that that 5 to 10% range. And for a lot of them, it's because this is something they're learning about. Getting access to this type of investment. It has existed for many decades, and it's where a lot of ultra high net worth people have built their wealth. But for the so-called millionaire next door, it's still pretty new. So what we actually see is we see a lot of people that are coming to us to make their first investment in CRE, commercial real estate, ever, and then we actually see a lot of repeat behavior. So people tend to make multiple investments in the first year after they've gotten their feet wet. So it is a moving target, but we see everything from their first $25,000 dip into the market up to millions of dollars and 25, 30% of their portfolio.
There's a question from our chat I want to get to. Rita Ford is asking, is this a REIT? No. Brent and Chris, can you explain how this is different than a REIT?
Sure. Yeah, that's a great question, and it's important to distinguish. So no, if you're investing in one of our projects, you become a limited partner directly with that real estate sponsor, right? So this is private equity. You're putting your dollars directly into that deal alongside, whatever other investors. There might be an institution that's putting in some of the capital, but you're directly investing in that project. So this is not publicly traded. It's not going to, dip with the market. It's completely independent of that, which is why this is such a great hedge. Because if the market tanks, this deal has no correlation with that project, right? And so it's a smart recession move. It's a smart hedge against, other, more volatile alts you might be, getting your toes in the water with. But it's not it's direct private equity into a project. Chris, we do have some funds, and I do think, just for folks that might be hearing about this for the first time and feel like I don't know enough to get started, we do have some funds that end up being a good sort of on-ramp. Chris, you want to maybe touch on that a little bit? Because I do think it's important.
Yeah. So we, again, we're not a REIT, right? Which is, typically they come in both public and private flavor, but we're not a REIT. But we do offer different things that look and feel a little bit more like REITs, because there'll be a fund structure that's diversified across, multiple sponsors, multiple geographies. But, the key underlying difference, and there's many, is that all of the deals that we're working with, they're structured as private equity deals. So they are one-to-one through the sponsor. An investor is in a deal with the real estate developer or the sponsor, versus this kind of intermediate, real estate investment trust structure that you would typically have.
Yeah.
So it ends up being a very different kind of deal. And when we actually offer those funds, they're structured as private equity funds. So you end up with different tax scenarios that can be advantageous depending on your situation. You end up with, the opportunity for a broader selection of developers. Very commonly REITs will be more focused on, small number of concepts. So it's just a very different approach to get you that exposure to commercial real estate, with, certain advantages based on, every investor's situation, whether those are tax or, whatever kind of exposure you're looking for.
Brent has said the key word a couple of times, which is hedge, right? Can you explain the use of commercial real estate as a hedge, why it works as a hedge, correlations or not that exist to the broader, U.S. equity markets?
Chris,
yeah, I can tackle that one. So, the short answer is, it's just far less correlated than what you're going to see in public markets, right? So public markets, you're really at the whim of, inflow and outflow of cash in any particular asset. So one of the things that you get when you go into a private equity structure, in exchange for being illiquid, you can't just take that money back off the table next month because you've decided you want it. What you get for that lack of liquidity is, the potential for stability, right? So you don't have this, this kind of whipsaw in and out flow of capital into that asset that's driving the price up and down. So, whether you're talking one specific deal, one specific property, or you're talking about the overall market, that dynamic just leads to less correlation with public markets.
Yeah.
So you just end up with something that's going to be a bit of a stabilizing force potentially, relative to typical public equity exposure. The other factor there is that you can make hedging decisions that are a little bit more nuanced relative to what you might be able to do. Certainly if you're trying to build up a single family rental empire in your hometown, or buy a duplex, you can still make plays. Say during the COVID window, you could have had the foresight to say, I'm going to lean into things that are going to benefit from a boom in e-commerce or data storage, or, and there's a lot of different things that you can do where you're looking at a more stably valued asset, but you can also make really nuanced plays that you might struggle to make either with one or two stocks or something like that, you have some thematic options that can really help you in fleshing out your portfolio.
A couple more questions I want to get to. One of them is there is a plethora of online real estate investing platforms. Just explain how Crowdstreet is different from the other ones.
Yeah, I'll start and Chris can jump in. So there are very few that do what we do, which is this direct equity into a project. There are other companies that offer funds. There are other companies that let you get in for $500 or $1,000. Our typical investments are $25,000. I think the biggest difference is the caliber of the investment. You know, we're working with the best real estate sponsors, developers, you know, in the country is the goal. And we're working with firms that, you know, have these track records that normally you wouldn't have access to. And I think there's a lot of folks that have, you know, they're doing single family homes or rental, you know, portfolios, or they'll buy a, you know, 100-unit sort of garden style apartment building. Those are fine, but they're very different. You're going to see on Crowdstreet, like I said, you're going to see institutional quality real estate, and that's really the difference. And you know, we've this year we've been anointed as the market leader in this, and it's because we focus relentlessly on this caliber of project. And I think that's the biggest difference is you're investing, you know, the folks that you're investing alongside of, you kind of say, these are the smart money. These are folks that are very successful in other industries. You know, these are doctors, lawyers, venture capitalists, you know, people that run major consulting firms. They're using Crowdstreet to build their portfolio because these are the kinds of projects they want to get involved in. And it's very different than, you know, some of the other platforms.
Yeah, the one thing I'd add to that is you can make a few different choices about how you participate in this market. So you made this point, Spencer. This has been around for decades, right? So commercial real estate developers, investors, they've been around forever. You can take a few different approaches to how you want to participate here. You can actually say, all right, this is a great market. I'm going to actually get involved with being on the sponsor or developer side of this market, and then I'm gonna put that stuff on the internet. And we have other firms out there that are doing something that looks just like that. Or you can say, it's a great market. I'm gonna become an investor and invite people to come invest in our funds. And we have competitors that are doing that. We made the third choice, which was saying, you know what, this is a really massive disconnected market. We're going to sit in the middle primarily, and we're going to connect those two. And we're going to say, you know what, there's some best of breed real estate groups out there. We're not going to be better than them at developing properties. And you know, there's literally millions of investors out just in the US that could benefit from this. We want to sit in the middle and connect them. And that's really the role that we play. And we do it basically to the nth degree compared to anyone else in the industry. And really the hallmark of what we've done is we've brought incredible deal flow, typically over 100 institutional quality deals a year.
Okay, we're up against the clock here. A couple questions from the chat. They're in the same vein. Is basically who can invest? Who can invest in Crowdstreet or in the deals on Crowdstreet?
Yeah, so today it's accredited investors, right?
Okay.
So that's the SEC guideline, you know, $1 million of net worth, roughly. You look at the definition, but effectively it's accredited investors are investing on Crowdstreet.
Okay. Are there plans to change that though down the line?
We're always tracking it. You know, we're always tracking what the SEC is doing. I mean, that article you shared at the top, right, is encouraging. We'd love to expand the access. But for today, that's where we're sitting.
I would just say the bar to become an accredited investor got a lot lower. Was it last year? 2 years ago? I don't remember when. But the SEC lowered the bar recently to be an accredited investor. It's not as high as it once was. Last one, and then we got to wrap it up. But how did COVID impact the commercial real estate asset class? We've all seen the headlines about the residential side of the market. Commercial maybe not as sexy because it doesn't affect as many people. But how has the last year and a half affected the market here?
Yeah, so it was funny when everyone got in lockdown in March, April. You know, the sort of everything halted temporarily.
Yeah,
and then it came roaring back with a vengeance in a positive way. What we found was because we're a marketplace, we're not buying and owning these projects, right? We're sitting in the middle. So what our investments team did, and we actually publish our investment thesis on our website, so you can see exactly what we're thinking about. They basically pivoted and said, okay, well, office is not probably something that our investors want to put a lot of money into right now, given the uncertainty. Hotels and lodging at that time were sitting at 7% occupancy. So like Chris mentioned, industrial, e-commerce, logistics, any kind of retail that had a grocery store in it, multifamily, these things just went off the hook in popularity. I mean, we couldn't bring these kind of deals to the marketplace fast enough. We were breaking records. Some of our projects were filling up, literally in like 2 minutes. So we did really well because our marketplace, by definition, is very agile. We're only bringing projects to the marketplace that we think investors want to invest in. So we were able to be really nimble, and the business is growing fast. Investors are signing up. We're getting, just the community is just expanding very rapidly.
All right, you can see the site there up on the screen, crowdstreet.com. Brent, Chris, guys, thank you both so much for coming on today. Again, this is an asset class that has historically not been that democratized, and you guys are helping to change that. So thank you both for that, and thanks for coming on today.
Yeah, great to be here.
All right, we're going to move this thing right along here. Our next guest is also in real estate, but that's the thing about real estate, right? Is there's so many nooks and crannies of the real estate market that we got to talk about here. So let's bring on Ryan Frazier, the co-founder and CEO of Arrived Homes. And there he is, Ryan Frazier. Good morning, sir.
Hey, Spencer. Good morning. Great to be here.
Great to have you. Let's just start with your background. I mentioned you are the co-founder and the CEO. So talk us through your professional journey and sort of what led you to thinking to yourself, I really should create this investing platform for people.
Yeah, absolutely. So my career has pretty much been as an entrepreneur, and really kind of through the full startup journey with a previous company that my co-founders and I had started. Grew up in Arkansas, kind of built the company there, moved to the Bay Area to be close to investors, got acquired by a company in Seattle, and so then moved to Seattle. And over about a 7 or 8 year period, as we were building that company, we were really wanting to invest in real estate. I think for us, we had each kind of had people in our lives, friends or family that we had just seen do really well owning rental homes. And we kind of each felt like one day we would start building our own kind of real estate portfolio as well. But as we were kind of building those companies, there was never just the right time. Early on, it was maybe not having enough capital to put into buying whole homes. Over time, it started to become more, just not having the available time to find properties or think about managing tenants. And then as we were moving a lot, really the idea of where would we be for the long term? Were we going to be settled down in a place where we could, invest in homes and be there to manage them, and kind of have that peace of mind that we could have eyes on the assets. And so, that kind of those barriers, I guess, prevented us from investing in rental properties. And I think eventually, over the last couple of years leading up to Arrived, just kind of kept asking that question of why isn't there an easier way to, own rental homes, but, without the kind of responsibilities. And that's kind of what led us down this path.
This is like the Airbnb from home, though, like you don't have to, like you said, it's responsibility, right? You don't have to actually maintain the home and talk to the guests and clean the sheets and everything. No, this is just, you get the same exposure, but you don't actually have to do any of that work.
Yeah, exactly. I think for us, it's about just limiting the barriers to owning rental homes. Right. And, those are the high upfront costs, but also the time kind of managing that. And so Arrive does kind of all of the work, finding these rental homes, and managing them, managing the tenant relationship over time, and ultimately just making it a passive investment for for our clients.
Okay, so we'll get more into that in a second. Let me just bring this up here. Just explain to us how Arrived actually works. Like for me, if I want to go on Arrived right now, open an account, how do I do it, and how am I actually using Arrived?
Yeah, so Arrive today is a platform for investing in shares of rental homes, starting from $100, up to $100,000 and beyond. And what we do is we basically, buy homes, break them into, let's say, 10,000 shares, and then allow retail investors to invest in those homes, really for any amount. Behind the scenes, Arrive then kind of does all of the work afterwards, managing really all of the responsibilities of the asset and making sure that it's delivering a great return for investors. For our customers, really their experience with the product is very similar to, let's say browsing Zillow, but then having a buy button right there if you find a home that you want to invest in. And so investors browse the homes on our website, they choose which homes they want to invest in, and then they kind of get the benefits of the passive income. So any income from a rent is passed forward, and any appreciation as the property value grows goes directly to our investors. They're full equity owners, essentially in an LLC that owns the home, and they get all the economic rights back on those investments.
This is scary for a person like me that likes to browse Zillow in the spare time. If I were to switch to browsing Arrived, you would have all of my money probably within a span of a couple of weeks. But I like the comparison. So how do you source these properties? Talk about that.
Yeah, so just kind of behind the scenes, Arrived is ultimately an investment company where we're finding these incredible properties that we want to then kind of bring to the website and bring to investors. Right. So our VP of investments spent half a decade with the second largest single family REIT in the US. And he's kind of leading the charge on our asset selection and purchase. And it really starts with finding the right markets. I think the cliche in real estate that location is, critically important, continues to hold. We spend a lot of time thinking about, what are those right markets and when is the right time to enter them. At the end of the day, if I were to kind of simplify it to a few kind of things that we look at, one is really just population growth. It's kind of the fundamental driver of demand in a market is, does it have a high growing population? On the other side of that is housing supply. And, how does that housing supply and the growth there compare to the population growth? Some cities like Houston, for example, have a lot more land mass where they can build a bit more aggressively. And so supply can keep up with some of that population growth. Other areas like Seattle, where we're based, really contained by a lot of different bodies of water. And so the ability to kind of build new home inventory is really tough. And so as we kind of look at those market dynamics, that leads us to determine where to invest. Today, we're in 10 markets in the Carolinas, Georgia, Arkansas, Colorado, and Arizona. And we're planning to expand to probably 20 by the end of the year, wow. Really given by that underlying kind of data, but also our investor demand. They're also telling us where they want to invest, and we want to be, everywhere they want to be.
Okay, so Ryan, what's hot right now?
Yeah,
you had to know that was coming.
You mean in terms of the markets, or
yeah, in terms of the market? Yeah.
Yeah, I think it's such a wild time right now because as we're coming out of COVID and a lot of people moving to different areas of the country, kind of moving to more of these communities outside of city centers, we're seeing single family homes over the last year appreciating at very quick rates. Yeah. Also driven by kind of the interest rate environment right now. So the reality is a lot of markets are hot at the moment, and that's also kind of a benefit and something that we're excited about doing is kind of leveraging our platform to get under contract with great homes, build relationships with builders so that we can get inventory further out and ultimately kind of make that accessible to our investors that might have trouble out there in the market on their own right now with so much demand.
All right. So can you give us a teaser? You said you're going to expand to 20 new markets by the end of the year. Can you give us a teaser as to maybe who that might be?
Yeah. So a couple of teasers, because we actually haven't even launched or announced all of the markets that we're in so far. So coming soon, we have kind of Denver, Colorado Springs coming up. We have some properties in Tucson, and then Atlanta, Georgia. And so a couple new markets coming online here over the next month or so. Investors can kind of look out for that. And yeah, I think when we think about the lower entry price point, being able to invest in a rental house for, let's say, $100 or $1,000 into individual homes, it's really about being able to build a portfolio and diversifying. Ultimately, that's kind of what we're unlocking when we talk to our clients. 92% of people want to invest on a recurring basis, most of them monthly. And so for us, kind of adding markets and adding a lot of homes is really about that, making it easy for people to diversify across the country and cities that they're excited about.
All right. What kind of returns can investors expect here? I have absolutely no insight into what the return profile is for shares of rental homes.
Yeah. Well, ultimately, it's going to follow the underlying performance of the home. So the way it works is that essentially, investors are investing in an LLC that holds title to that home. They end up investing about 35% of the value of the home, and we put about 65% long-term debt, a mortgage on the home, to basically give investors the benefit of leverage on the income or on appreciation. I'll say that all of our offerings are qualified with the SEC. And that really allows us to make this available to retail and accredited investors alike. So we aren't able to kind of share projections. So all the kind of data and performance we share is kind of backwards looking. And for our last dividend payment, which we pay out quarterly, our homes range between about 5.5% to 6.5% on the annualized dividend yield. So the yields people might expect. And that kind of compares to, like, if you're investing in a public REIT, where today they're maybe in the 2s. So getting a 5.5% to 6.5%, I think that really shows the benefit of being close to the real estate and some of the benefits of owning the underlying asset. Investors also get all the appreciation, and in this market, I think we've seen Zillow estimates and appraisals grow 10 to 15% over the last year. It's definitely a unique time in the market. I think historically, residential homes have appreciated on average more, just under 4% per year. Yeah. So with leverage, that's an idea of kind of what we expect when you own these homes.
Yep. I'm curious what you've seen from your investor base in terms of behavior. Our last guest said typically, these are for commercial real estate, 2 to 3 year investments. I'm just wondering what is the time horizon, if there is I don't know, recommended, if it's not the right word, but in terms of maybe behavior, what have you observed as far as how long investors have been buying and selling, and what the turnover is for these shares of rental homes?
Yeah. And in general, I think, the way that we're looking at it for each home we're buying is really about a 5 to 7 year kind of investment period per house. We might hold it, a little bit shorter or a little bit longer, depending on, our view of that home over time. We're really trying to own it during the kind of best kind of useful life of the home, and during a period when there's kind of low expected operating expenses. I think one thing very unique about Arrived is that we're buying very new homes. So I don't think we have any home older than 2010. Wow. We're buying a lot of new build homes. And really that is about, one, our belief in that segment of the market, that people are looking for, quality rental homes at the moment and quality assets. Two is when we go to sell that home, there's a larger buyer pool because it could be really anyone who wants to own that asset. And then just the consistency in terms of operating expenses. We don't want to have, anything unexpected happen, and really buying newer homes kind of protects that. And then so we're kind of investing for that 5 to 7 year hold period. But I'd say, we know that investors may want to basically sell earlier.
Right.
And so today, investors can request to sell shares after the first 6 months, and essentially they'd sell them to other investors on the platform. Long term, we'll kind of build that more integrated into the product directly. But today, the shares are able to be freely traded. That's another benefit of the SEC structure that we have, is that investors can sell to others, at any point after that time.
So, like, do you ever step in or would you ever step in and provide liquidity, or is that just not a thing?
Yeah, so we're actually figuring that part out today. In general, I think really that's just making sure within the regulation that we're able to do that we're properly disclosing that, hey, if we can't find a buyer for you, that we would step in. But for now, it's just an investor to an investor sale.
Got it. And what about the very end of the cycle? This is from Manny in the chat. I mean, I guess how is in terms of the appreciation? Is it just a case of the home gets sold and that's that?
Yeah, I would say that's probably the way that most of our investors will kind of feel the benefits of appreciation. We are integrating with the Zillow Zestimates and kind of tracking that for every property that we own. And so we're updating those on a recurring basis for our clients' accounts, and they can see kind of how the Zestimate of the homes they own or of the shares they own are kind of moving over time. But ultimately, they would realize that appreciation when we sell the home or when they decide to sell shares to other investors. Got
it. Something I've been asking everyone, and I will ask everyone on this show today, is the last year and a half, man. How did COVID sort of impact not just your business, but the deal sourcing, the liquidity, the asset performance? I mean, we've talked about the performance. Everyone knows, it is no secret now, into single family homes are going to the moon. So what has the last year and a half been like for you?
Yeah, I think, like everyone, it's been kind of a whirlwind and I think really tough time for a lot of people. I think that it's been a very interesting time to be in single family homes. When we saw early on a lot of the volatility in the stock market, I think there is this demand for owning tangible assets that have this underlying real value that that doesn't move quite as much, especially when you think about the comparison to public real estate funds and how those traded during those times. I think that's for our clients, they're definitely seeing that and thinking about how can I diversify away from the stock market against my holdings there, and kind of access those income streams. The market in general, as we talked about a bit, I think has been really wild. I don't think anyone could have predicted that a pandemic would then lead to a rush up in home prices in the way that it has. But for our clients that are participating now, they've certainly been enjoying the increase in values or valuation reports and estimates for all of those properties. And so it's been, at least that side of things has been really fortunate for folks who are starting to to buy into homes.
All right, here's a question from the chat that I shamefully admit I did not think of. Alan did, though. How will blockchain factor into this? Is there a blockchain play here eventually?
Yeah, I think the interesting thing is, we're kind of adjacent to that. The way that our product works is very much, in line with those practices. We've chosen, we haven't built the product on a blockchain today, but we do track investor ledger. And really, it's just, I think that, we kind of, with going through the regulatory cycle and making sure that this is, an SEC qualified offering available to, retail and accredited investors alike, we wanted to kind of hold off on any additional scrutiny while, kind of that side of the industry is, I think, under kind of a magnifying glass at the moment. But ultimately, again, like, I think the promise of what we're doing, allowing people to own, buy and sell shares of rental homes, build and invest in a portfolio and kind of tangible assets is very kind of aligned.
So you're saying there's a chance. Okay, I'm wondering, the first thing I thought of when I saw your company is rental homes. I'm sure there's some seasonality at play here. What kind of seasonality do you observe, be it in, again, deal sourcing or liquidity on the market or whatever? Because I would imagine, this factors into what the markets you go into.
Yeah. So there is that. I think there's, kind of two components to our model that we lean into during those times. So one of the reasons we're expanding across markets is so that if at any time, any one market is more challenging to acquire homes in, maybe there's just less homes available or more demand. We see a ton of institutional investors obviously investing in single family homes right now. So it kind of allows us to divert attention at any given time to different markets to kind of place our bets there. In general, I think, single family on the rental side, we look at, the time of year when leases are going under contract or renewing. And for us, a lot of times we're doing at least a 2-year lease. And we're trying to time those lease renewals with the summer when we go, under contract, just kind of protects the rental value there. But that's kind of one thing to kind of think about in terms from a seasonality perspective, is just times of year when there's higher rental demand, people moving.
Man, Ryan, I got to say, something you just said scares the bejesus out of me. And it's true, which is you're seeing a lot of institutional investment in residential real estate. And if you don't believe Ryan or you don't believe me, just Google private equity residential real estate or Blackstone residential real estate, because it is happening, right? The big guns, right? The smart money, they are getting into the space and in many ways competing with people like me, for example, individual home buyers, right? And that's the thing that's happening, Ryan. I'm wondering if the increase in institutional demand for this asset how that's changed your world at all.
Yeah, no, I think that's absolutely right. And really, with where interest rates are at, I mean, they're just chasing that yield. And I mean, the amount of institutional capital coming into single family specifically, right? It's wild. It's wild. And, I think that in some ways we're benefiting from the start of that, after the housing crisis in about 10 years ago. Those early kind of institutional investors like Invitation Homes, they really kind of created a playbook for mass managing single family houses. And there's created this kind of cottage industry that's supporting, that industry. And for Arrived and ultimately for, clients who are investing through Arrived, we're really kind of leveraging some of those playbooks and bringing that to, retail investors so that they can build and access these, similar single family portfolios, compete with institutional buyers, which just aren't going away based on the trends. I mean, we know that that's going to continue to grow. And so, we kind of want to level the playing field, make it easy for everyone to kind of benefit from that same investment thesis.
And look, I know the interest rates are low, but let's be honest. Home buyers today, first time or otherwise, you are competing with these firms for the down payment, frankly, and the down payment is the bottleneck for most people, most regular people here. And I'll be honest, Ryan, I've thought about, I always thought that my real estate exposure would be my home. But maybe the best way for me to get real estate, invest in real estate is not through a home. It's through a platform like yours or a platform like Crowdstreet, right? I mean, that may end up having to be the way for people, because the bar to the down payment is only getting higher. And so even, yes, rates are low, but I mean, for many people, it's just going to be an insurmountable bar to clear right off the top. So yeah, I mean, platforms like this I'm bullish on them for that reason and that reason alone. I'm curious what you've observed, or I don't know if you've done surveys or otherwise, in terms of how your investors on Arrived are allocating to Arrived. How much money they're putting down. It's the minimum is 100, but are you seeing a lot of people do 100? Is it 1,000? What is the typical behavior there?
Yeah, and I think really it's a wide variety. I mean, we have people who got started just kind of testing with $100, and people investing 100,000 or more. I'd say our average investor today has invested about $2,000 in about 3 to 4 homes. And to give you a sense of scale, we really are pretty early in this journey, but over the last few months, we've sold over $7 million in real estate, in rental homes, across those markets. And yeah, so it's kind of fun to see, even though we're kind of at the early goings, there's a ton of demand for this. And I think the biggest behavior that we believe in, and that I think it's been fun to see, is just the fact that the vast majority of our clients investing on Arrived are diversifying. And when you think about like the kind of growing down payment as asset prices grow, I think that's what gives us a lot of confidence that fractionalizing or breaking these assets up, kind of like a stock split, is sort of inevitable for that reason. And we hope that the minimum investments make it such that people can create a portfolio and they can diversify across multiple homes, but still have control and still be kind of close to the underlying asset. Since I think a lot of people, kind of want to get into, be a landlord or a rental property owner, but it's hard to start. It's hard to take that first step, and that's really what we're trying to enable.
Yeah. How do you decide how many shares to break a home into?
Yeah. So today we're taking the home and dividing it such that each share is $10, just for simplicity in terms of making it easy for people to pick the investment amounts. So the share count for each house is a bit variable. Each share starts at $10 per share, and then the $100 minimum is per house. So 10 shares.
Got it. And then just as we wrap it up here, Ryan, and by the way, if there's any questions from the chat, please drop them in. Do you have a favorite market right now? I don't know. If you follow the space, I'm sure you follow the space, but do you have a favorite market? I don't know if you want to say.
Yeah, well, this one's personal. I grew up in Arkansas. We have a lot of homes in Northwest Arkansas, which is the headquarters for Walmart. There's a huge supplier community there. Companies like Procter & Gamble and Coke that are, driving employer growth. And then, it's a great community that's seeing a ton of growth. So it's been fun to bring that market to investors. It's similarly seen the appreciation kind of growth over the last year as other markets. It's got those great kind of balance of yield potential and appreciation. And then, for me, the personal interest, I think everyone will kind of have their own areas that they're focused on, but that's one that I enjoy.
Yeah. I just put the link in chat, everyone. I'll put it up on the screen here to make sure you all have. There it is. One from the chat, and then we'll let you go, Ryan.
Great.
And I think we already kind of addressed this, but can an investor select their house? Yes, Rita. Investor can select which, individual.
Yep. You can choose individual homes and pick and choose and build your portfolio that way.
Okay, we'll do one more, only because this is a juicy one from Chef Remy. There is a massive housing shortage and also a materials building materials supply shortage right now in this country. I'm just wondering if you have thoughts on, or Chef Remy is wondering if you have thoughts on.
Yeah, I also saw that the comment from Chef Remy about Charlotte. We've got Charlotte houses coming online, so people look out. We just sold through one last week. And yeah, from the supply side, I mean, we have the same challenges of everyone else. We really look to partner with people in each market that can give us access to, great supply of homes. We're also partnering with builders in each market to basically go under contract with new development homes further in advance, both to kind of, one, make sure that we're kind of doing our part to create more inventory, but to kind of make sure that we have that access long term as well. And with kind of investing primarily in newer homes, we kind of have the ability to do that.
Okay, last one, I promise.
Yep.
Okay, from Solar Up, you can put your house on a ride and live in it, right?
Yeah. So everyone who's living and renting in the home can also co-invest in that home or in any other home on Arrived.
Awesome. Guys, Ryan Frazier is the co-founder and CEO of Arrived Homes. Link is in chat. Link is in description. Link is on the screen. Ryan, this has been really interesting stuff. Fractional ownership of rental homes. Crazy. What a time to be alive.
Yeah. Thanks so much, Spencer. This has been fun.
Lot, man.
Thanks everyone for listening.
All right. Let's keep it going here. Look, that's the crazy thing about real estate, right? Is there is no one right way to do it, right? So far, we've heard from Arrived, right? Fractional ownership in rental properties. We've heard from commercial real estate platform that structures the deal more private equity style. And our next guest is also doing commercial real estate, but not in the private equity style, in the more traditional REIT style. So let's get Aaron Halfacre, and I can't believe, I'm sure he hears this a lot, but his name is just so apropos. He's the CEO of MODIV, and let's get Aaron Halfacre from MODIV on right now. Hey, how we doing, sir?
Hey, Spencer, how are you?
Good. I'm sure you hear that about your name a lot.
I grew up. People were like, "Why? How come you're not a whole acre? Were you a quarter acre before you got married?" And then when I got into real estate, they're like, "Oh, wow, that's great." And it's worked well for me.
Yeah. All right. Tell us about MODIV and how it works.
Yeah. So MODIV is a real estate crowdfunding company. It's one of the original real estate crowdfunding companies. As you pointed out, we do it in the form of a REIT, and so it's a rather unique structure. We're the only real estate crowdfunding company that's built this large of a REIT, and we also have a publicly traded security. It's a preferred equity security called MDVA. But crowdfunding, a lot of people know about it, right? They hear about it, but they hear about it in different ways, right? There's different types of crowdfunding. There's a plethora of crowdfunding companies out there, and they're all working at it from a different angle. As you pointed out, there's a lot of ways to slice this market. There's a lot of ways to own real estate. I think we take the view that looking at owning high quality commercial real estate, the stuff that pensions and institutions and the big boys usually own, and providing it a way to individual investors is something that's unique and valuable for the long term, right? So it provides real income and it provides capital appreciation. But how you go about owning it is really sort of key, right? So you can own it in a private vehicle that has no transparency, and maybe you get a K1, or maybe you get some liquidity, or maybe you don't. What we've built is a path that allows people to get, SEC filings. So you get Qs and Ks. You can have redemption abilities. You get income. You get appreciation. You get a lot of transparency. But most importantly, when you buy the shares of the company, you actually own the crowdfunding company too, right? So I know earlier on today we had Crowdstreet. Crowdstreet is a great company. They do what is called syndication as a type of real estate crowdfunding. But when you buy the deals, you don't get to own Crowdstreet. That's a separate deal, right? That's a separate thing. And they did, they offered shares maybe a while back, but they haven't offered them recently. But every share you buy here provides income, monthly dividends, plus real estate, plus the crowdfunding.
That sort of took away from my next question, which was what are the benefits of doing this way? But I guess you just sort of answered it. So maybe I skipped over the question I always like to start off with, which is just tell us about your background and you've been at you've been at MODIV 3 years now, 2018, right?
Yeah, yeah.
So
So we created MODIV out of actually M&A, so mergers and
okay,
acquisitions. We merged two REITs together, internalized what used to be the Rich Uncle's platform. I actually have a history in capital markets. After I went to, I've been in real estate and sort of real estate capital markets for over 25 years. Um, Before this, I took a REIT public. It was Cole. We sold that. We listed that. We sold that. Then I joined another REIT called Campus Crest, which was a student housing REIT. We took that private, sold that into private equity transactions. Before that, my career, I spent about 11 years at BlackRock, running institutional real estate, as also running an equity fund and things like that. So, steeped in the markets, love real estate. I was a realtor when I was 18 years old. I became a realtor in Hawaii. Then I got out of it when I was in the military. Been in real estate forever. Just love the space. Specifically went to crowdfunding and the fintech enablement portion of it about 3 years ago. So I was at Realty Mogul, which is another real estate crowdfunding company, as president there. Learned a lot, and then came over here and sort of created this new company.
what was it about the crowdfunding model that sort of got you going?
Yeah, well, I've done institutional, I've done retail, I've done private, I've done public, and so I've seen all aspects of the capital market space, and enabling technology to real estate was something that I thought was really going to be interesting and a trend that was going to be around for a long time. In fact,
Yeah.
I see a lot of parallels to what real estate crowdfunding is doing to what the financial services companies did, Schwab, Vanguard, Fidelity, 25 years ago. And what I mean by that is they took an asset class that's been around for a long time. They added technology, which allowed two things to happen. It increased the access to individual investors, and it lowered the cost to own it. And by doing so, you start to get more scale. And then from there, you see consolidation of the players in the space. And then from there, you start to see public listing events. And now, this day and age, we don't think about loaded mutual funds, and we don't think about paying exorbitant commissions, if any commissions at all, for stock trading. But that wasn't the case 20 years ago.
I take it for granted, honestly. That's the truth, right? I take it for granted. I haven't had to worry about a load fee ever in my life, right? So
Right, and it because of the companies that were pushing the vanguard or the fronting
right.
leading edge and adding technology and driving those costs down. That's what we're seeing in real estate now. So it's an exciting time, right? Arrived Homes just came on. Getting to own a $10 a share of a rental property wouldn't have happened without technology, because otherwise it would have been too cumbersome. You'd have had to send paperwork and do all these other things, and so we're increasingly making real estate more ownable and obtainable.
Yeah. So let's talk then about MODIV and how it actually works. And I've got some stats up on the screen there, but just as an investor, how do I use MODIV?
Yeah. So MODIV we have 38 properties right now. We've got several under contract. We buy retail, office, and industrial properties. These are single tenant, long-term net leases. So we have, for instance, Husqvarna, who makes chainsaws and dirt bikes. We have their North American R&D headquarters, right? So real mission critical property for them. They're on a long-term lease. They're only the tenant in the building. Another example is we have a cold storage facility for Taylor Farms. So if you go in the grocery store and you see bags of lettuce or these mixed salads that everyone's doing now, typically it's going to see two brands, either Taylor Farms or Earthbound Farms. We own one of their facilities where it's first mile production, right? So Brussels sprouts and lettuce comes off the field, so they wash it, boom. So we own these types of properties. They're mission critical, they're sticky, the tenants like to stay in them, and so they pay us rent. We collect that rent and we distribute it in the form of dividend income to our investors. That's the real estate side of the house, right? So we have a real estate team, 20 plus years across the board, have established a really solid real estate team. And then on the other side is the technology and the crowdfunding. So we've raised over $450 million of assets, all online. They never had to pay a commission. And the investors own both of those aspects of the company. And our goal is to continue to just grow, right? I'd say we're relatively small. We're relatively new in the space. Our peers, and we benchmark ourselves to a lot of the publicly traded REITs. I think we could be 3 or 4 or 5 times this size in 2 years and think nothing of it. It wouldn't even be scraping the market.
All right, so let's talk about the deal flow then. How do you guys source? How do you guys analyze properties that could be a good fit or not?
Yeah, so the net lease market is a pretty established market, right? So there's two ways you go about it. You can do on-market deals or off-market deals. Our chief investment officer was at Realty Income. He was at Cole. His team spends a lot of time sourcing off-market deals. So we'll talk to CFOs and CEOs of companies and say, hey, look, do you want to do a sell leaseback? You might have a warehouse or a manufacturing facility. We'll buy the property, we'll lease it back to you, and we'll structure a long-term lease. That's one aspect. Those are the off-market types of opportunities. The other ones are where the brokers, the real estate brokers are showing you, and they'll do auction processes or they'll do bidding processes, and we'll bid on those. So our pipeline right now is probably about $200 million of deals that we're looking at. What we try to do when we go in, we underwrite every deal from an FFO or funds from operations sort of perspective to make sure it's accretive on a per share basis. So we're looking not only to make sure the purchase price is right, making sure that the real estate's the right location, the tenant's strong, it's good quality, but that when we drop that property into our portfolio, it's going to add pennies or more to our share price over time. And so we're underwriting that. We tend to write, it's like a 10 tab financial model, and then we drop it into Argus, and then we use Yardi, which is accounting software. So it's a pretty robust system that we learned when I was at BlackRock and other things.
I was watching some videos that on your YouTube channel, and you said that one of the first things you said in one of your first videos was, as a real estate investor, there are all sorts of things you need to think about. What are those things? But so we all know location, right? But what are those other things that you need to think about?
Yeah, so real estate's an interesting beast, right? So it's been around for a long time. The knowledge curve is not that steep, but there are pitfalls along the way, right? So some of you can't learn it all from a book. You have to, unfortunately, learn a lot of it from experience. So I remember when I was at BlackRock in 2008, the Lehman crisis hit. We were up all night looking at what's going to happen to our real estate, because it was a leverage-induced panic, right? And the crash was really driven by excessive leverage, whereas last year we saw a sell-off in the broader markets, and in the capital markets you saw a temporary freeze because of a pandemic. So each time these things happen, you have to have the experience, and it's hard to know. So when I think about real estate, location is obviously key, but demand for that location is also key. And that's what you have to decide, is what is the tenant doing, right? So if you are looking at retail locations, you'll oftentimes see, and like for instance, I live in Southern California, you'll oftentimes see there'll be a Chick-fil-A, and then right across the street will be an In-N-Out. And why is that? Because they both do the demographic traffic studies to know that's a good market. So when one does it, they say, well, it's got to be good, so they build the other one. If I was going to go put a pharmacy there, it may not be the best thing. So the type of tenancy that you have in that location is super important. Then it's the quality of the tenant, right? So if I have a no-name payday cash loan sort of thing, that's not a good tenant. They're not going to pay. But if I have a Walgreens, I know they're a good tenant. So you look at the quality of that, and you combine those together with what is your financing, right? I think the allure right now with low interest rates is people say, well, this pencils. This deal pencils today. I'll pay more than I think I would because I can get cheap financing. That only works if you can continue to have that cheap financing. And we know that long-term cycles, you're going to, we should see rising interest rates somewhere over a 5-year, 7-year cycle, and then your spread's going to narrow, and it may not be as lucrative unless you have growth in your cash and your rents.
Yeah, I guess that answers that, why sometimes we'll see a intersection with 3 gas stations out of 3 of the 4 corners are gas stations, and you're like, guys, come on. But you're right. They all do the same studies. They're not dumb. They know, right?
Yeah. And then for other asset classes like office, which is at a unique point in time, because a lot of us are not working in offices right now. We're not sure if we're going to go back or what's the demand. Offices are really sort of GDP and job growth driven, right? So if you have economic growth and there's a lot of jobs, then offices tend to go up. But then you have those wax and wane. Hotels, right? The business cycle, the daily rents that they reset. So every asset class has got a lot of nuance to it. And so I think what I found is, particularly with the commercial real estate, because you got a lot of smart players coming at it from different angles. You got some with immediate investment objectives. You got some with really long term. Is that if you don't have the experience, you might be able to buy it, but you might get burned later.
Yeah. So let's talk a little bit about the commercial real estate asset class and where it's at right now. You mentioned interest rates. In theory, on paper, they should go higher eventually. How much higher is anyone's guess? But where does the market stand right now? As we have reopened. We're coming out of the pandemic here. It was a pretty scary. Imagine your spring of last year professionally was quite terrifying. But as we come out of that, where is the marketplace right now?
Yeah. So stepping back before COVID and looking at sort of the last 3 years, cap rates or capitalization rates, which is sort of a 1-year yield on your NOI
Right.
or net operating income, have been compressing. They've been coming down. Why is that? Well, we've got cheap money out there, right? And people are seeking yield. So people keep buying and buying. Cap rates came. When COVID hit, you're right. It was a really interesting time, and I drew the parallel to the Lehman crisis or the debt crisis of 08, 09. That was leverage induced, and so if you had too much leverage, you were going to get pinched. Here, it wasn't leverage induced, and we weren't sure when we go into. You think about what commercial real estate does. It takes a business and its customers, either their employees or their tenants, and they allow them to physically co-locate under one roof. But when you have a government entity that isn't related to that economic cycle, say you can't stay in this building, you can't use this building, then you're like, as a tenant or as a landlord, you're like, well, what's this worth, right? How am I going to collect my rent if I can't use my building, right? And so there was this period of time where we're like, this is interesting. At the same time, you saw PPP loans going out crazy, and all the banks were like, we're not going to worry about your mortgages right now. We're going to go put out some of this government funding. So you saw the capital markets freeze for about a 4-month period of time. We were lucky. We collected every dollar of every rent that we wanted over the year, so we were good in that regard. And we were pleased with that. But it was a dark time, and you couldn't see through the fog. Coming out of it, though, as soon as the market sort of thawed back out, and we've seen a lot of this if you look at publicly traded REITs, they fell off as much as 50%, and now they've largely rebounded, not completely. And you've also seen this in the real estate markets, that cap rates have come back to marching back downwards. We're seeing some cap rates get so low that it's just not sustainable, that trend, right? So if you're buying now, you may, you should be very cautious and you should underwrite. That said, if you're thorough with your underwriting, if you're really looking at it, you're digging deep, you can find opportunities. Example, about 2 months ago, an off-market deal, we bought a Raising Cane's. So Raising Cane's, for those who don't know, is it's a pretty good chicken franchise. My daughters like it. I'm not a big fan of it, but anyway, we bought one in San Antonio, right next to a hospital, right next to a high school, right? So lots of people are always going to be eating it, and we bought it off market, and we bought it probably 50 basis points cap rate wider than you could have bought it in the regular public market. So there are deals that you can find, but you got to work at it.
I'm just curious, in the depths of last year, what your I don't want to phrase this. I'm just curious what your just rent collection was like in your properties. There's a lot of talk about defaults, companies not being able to pay their rent.
Yeah, it was an interesting time. So if you think about the commercial real estate market, you've got a lot of attorneys that service them. You've got brokers. You've got 1031 buyers. So these are individual buyers who are doing tax deferred exchanges. You've got emerging funds, these smaller funds that are doing. You've got the big institutional players. So you've got a lot of constituents out there.
Right.
And right when COVID hit, there was this pause, and so we saw some players go out, some landlords, and go, "Oh, we're going to give you rent relief, so just stay tight." Right, so that way, don't panic. We'll give you some rent relief. We saw other landlords say, well, let's wait to see if the tenant asks for rent relief. We were one of those. We were saying, let's see if the tenant really needs rent relief. And then we gauged it. And then you started seeing brokers and attorneys start cutting and pasting ways. Ask your landlord for this, or ask your tenant for this. And it was interesting that I literally had a tenant who was a gas station owner who copied something that I just seen in an email from a lawyer the day before about what the 5 things you need to ask. He copied it in an email and sent it to me, and it was asking for rent relief. Found out he didn't really need rent relief. He just thought, I'll ask for it and see what happens.
Yeah.
And so in our situation, we collected our rents. We had one black eye, and that was a 24-hour fitness that we owned in Vegas. And as you know, 24-hour fitness went bankrupt. At least we were able to find a new tenant and then sell it to another REIT and sort of minimize our impact there. But with the exception of that, every one of our tenants paid all their rent. We have 100% occupancy. And so I think that's a testament to, one, buying them right way back, and 2 is managing them on a current basis.
Yeah. This one is a little bit easier to digest because it's the REIT structure, and I think more people are familiar with that. It's not as foreign to most investors or retail investors especially. But that being said, I guess, like, what are the biggest questions you get from investors? Is it about the marketplace, or is it about the structure, how it fits into a larger portfolio? I guess what are the questions you get the most?
Yeah, I think there's a wide gamut of questions. We get questions
Okay.
like how do I invest? And that answer is you go to MODIV.com, go online, and it's a pretty simple process, and you can invest as little as $1,000 or $100 a month,
Right.
and you'll start getting dividends. So that's one question we get. Like, what am I actually owning? That's another one. So you're in this case you're owning nearly $500 million of real estate, commercial, paying monthly dividends. We pay $1.15 per share per year, and that's broken up in 12 payments. That's your income. That's what you're getting automatically. Plus the NAV, or the net asset value per share, changes every quarter. So our common shares right now are not yet listed. We anticipate listing that next year. So we will be a fully listed company. We have a preferred security that's out there. It's called ticker MDVA, that pays, I don't know, like a 7.25% interest rate. That's out there, and people are able to trade that one today. But otherwise, you buy into the common, and then you hold it. You can redeem it if you want. It's somewhat like a mutual fund. There's not 100% liquidity at any given day, but we routinely allow people to return their money. It happens. People ask, what kind of tax documents am I getting? Right. So a lot of the crowdfunding, you're getting K1s, and if you haven't done a K1 before, it can be a conundrum, right? That your CPA doesn't really like to do them. It's a little bit harder. We give, as a REIT, we give 1099s. So everyone's used to 1099s. It makes it super simple. I think the other ones that people say is like, what do I, who's in charge? And a lot of times, a lot of these deals, you have a sponsor, so they're paying fees, right? So you're buying into this investment. Maybe it's a home, or via a security, or maybe it's another fund, and you're paying an acquisition fee and a disposition fee and an asset management fee and a performance fee, and pretty soon you're paying a lot of fees, but you have to read the fine print. The way we've structured ours, there are no fees. There are costs of a public company, so we publicly file, right? So we do Qs and Ks, just like everyone else. Next year we'll be traded, so we have. But there are no fees. We're no hidden fees. We're not charging fees for it. Our view is real estate itself is a great asset class, and you can structure it, but it's a long-term play, right? Everyone who's buying real estate, I think there's a risk out there, and there's maybe a false appetite. People want to buy real estate, and they want it to double by the end of the year. And I think real estate is a long-term asset class. And if you're getting those types of returns, I mean, they do exist sometimes, that's not without risk. And people need to be mindful of that.
Well, do you think that's because they heard from their neighbor 3 doors down that they just sold their house for some ridiculous premium, and they thought, I could do that too? And then next thing you know, you're levered up to your eyeballs. I don't know.
Yeah.
Maybe.
Leverage is a really dangerous tool, right? And it cuts both ways. So it's great when the markets are up, and it's just terrible when it's going down. And in Southern California, real estate prices have gone, and residential real estate prices have gone through the roof. And it's and people, I talk to people, and these are great hard working class people, but they're putting like 5% down, right? They're buying these things, and it's like there's no equity.
5%?
You miss a small window, you're wiped, right? That's not how we do it, right? So our leverage is less than 50%, right? So there is a big margin of error. So we could get whipsawed in the market, and you're still going to be throwing off that income. We're still going to be covering that dividend, and so we, like the sort of bigger commercial guys, we don't put a lot of leverage on there because we've seen it wipe entire. Look at Lehman Brothers. That was a debt thing. There's numerous REITs, Washington Prime, General Growth back in the day. Huge companies got wiped out because they had too much leverage. So you got to be thoughtful about it, for sure.
Well, 5% is that's something. Anyway,
all right. Think about the motivations. Banks need to get money out, right? So if they put money out into the system, then that increases their lendable base, and then they keep doing it. So they got cheap funds windows. They're putting the money out, and they're going about it.
Sure. I want to put this slide up just because it just shows the ecosystem that we're talking about here, and again, the different ways to get exposure to real estate. I'm with whoever said that in the chat. Aaron Bryan said in the chat, real estate is such a good investment. Sure, yeah. As an asset class, I'm I'm totally with you, man. And there's just so many ways to go about it. So I just put this up to hopefully help you all understand where MODIV fits into the space. And it's a bit of a two-sided coin because it's real estate, but it's also crowdfunding, and that adds a whole wrinkle that Aaron's been talking about here. So again, going back to what you just said, you're going to list on the NASDAQ next year, or at least you file
NYC.
All right.
So we already have an NYC big board listed preferred security.
Okay.
REITs generally like to do NYC if they can. It doesn't mean they can't do NASDAQ, but generally like that. Our goal is to list the common shares, and we have probably 9 million shares of common outstanding already, and people come in every day. So every time when you come and makes an investment, they're owning shares in the common stock, right? Yeah. And so our goal is to list as early as next year. We will probably continue to look to do more M&A. So we've done I have a long history of M&A. M&A for us could be either real estate deals or crowdfunding companies. And we think that the interplay between sort of the fintech crowdfunding aspect and real estate is here to stay. And there are a lot, as I mentioned before, a lot of parallels to financial services. So we think as Schwab and Vanguard and Fidelity sort of merged their business models over years and became sort of these very large businesses, we think the same is going to happen to real estate. Real estate crowdfunding. It's still small. I have. We have $500 million of assets. The REITs I ran before were $7, $10, $12 billion. So this is still a small portfolio, but they're all small, right? Crowdfunding is still small. And this slide kind of indicates the different business models. So as I mentioned before, Crowdstreet is a syndicator. Syndication in real estate has been around forever, right? And the old model was there was some guy and he'd go to the country club and he'd say, look, I got this deal this guy's doing. And he talked to his friends and they signed the paperwork, and that's how you got a deal done. It was a country club deal. And now syndication has moved to digital. It's online. And so what Crowdstreet has is a two-sided marketplace. They're constantly going out looking for sponsors who have deals, and then they're constantly going out looking for investors who want to buy those deals, and then they match them, right? And that model has it's really sort of momentum driven. You got to keep doing deals, got to keep doing deals. And they're doing a great job of it. Real Crowd is another company that kind of uses that model. At the other end of the spectrum is what you call asset aggregators. So Crowdstreet, Crowdstreet shows you a deal, Crowdstreet doesn't typically, now they're starting to do some funds, but they typically and historically did not own the deal. They didn't own title to that property. The sponsor did. And you were basically being what is called limited partner equity, and you'd go into that deal and you get an LLC. Asset aggregators, on the other hand, they buy the property. They own title to that property. They're the ones who can put the financing on. They're the ones who make the executive decisions about that real estate. So Fundrise is a model that does that. MODIV is a model. The difference between the two of us is we are internalized. So the management team, the crowdfunding company are all in the same security that you're buying. In Fundrise, you're buying these different e-REITs, and they do a great job. They buy these different e-REITs, but the management team and the crowdfunding company is in Fundrise, and you don't own that necessarily. And then there's others who are trying to do both, and that's what we sort of a hybrid. It's the best and worst of both. So, a Realty Moguls, who I used to be at, they'll do syndications of individual deals, and they also have REITs, right? Equity Multiple is sort of doing fund-to-funds models. There's hybrid models out there across the board.
Aaron, just to give everyone an understanding here, I've asked this question of our previous guests as well, is how do you see investors that use MODIV allocating to MODIV as a piece of their overall portfolio? Is this you see this being a core position? Is it, or, I guess as a percentage of assets? Or maybe you can speak to yourself personally. Well, maybe not you because you're the CEO. But...
I'm probably not a good example because I concentrate my portfolio. Like for instance, I have over $1.2 million of my own cash money into the company. Right, I believe in it. Yeah. I've had it in there for a while. So and then my income is from it. Not a good generally speaking, but don't do that unless you're really close to whatever occupation you're doing. Right. For me, look, I think the best way to think about real estate, if you're taking it from a sort of where the smart money is sort of that sort of endowment foundation model, right? So if you look at the Yale endowment model, foundation models, what they do is they tend to allocate a percentage of their portfolio beyond just stocks and bonds and into alternatives, right? So this is what we're talking about here is alternatives. Real estate is one of the classic alternatives. Allocations for the institutional shops tend to be between 5 and 10%, right? 10% being sort of the ideal number. And then what they're looking for real estate is they're looking for real estate to provide income and the adverse price volatility. right? So when you've got your stocks gyrating around, your Tesla's going up and down, you're looking at that could be more speculative than your blue chip name that you're owning. Real estate's designed to provide you income and capital appreciation, but it's a counterbalance to that portfolio. So a lot of our people are looking. They're not going all in real estate because look, real estate has risk, like any asset class, right? You have liquidity risk, you have price risk, but they're putting roughly 10% of their portfolio. Sometimes they're putting more, sometimes they're putting less. If they're just starting out, I think the encouraging thing about that is a lot of people say, well, I don't have that much money, right? I got $10,000 in my PA, and what do I do with it? And so $1,000 into real estate is a good way to allocate, because there's something very emotional about investing as much as there is about financial, and it's about knowing. Like here, you get to know that you're owning a slice of $500 million of commercial real estate, and it only took you $1,000, and you didn't have to do any of the headache. Right, and so it doesn't need to be a big piece to be a satisfying and a complementary portion of your portfolio. So that's how we generally view it. We try to discourage people to put too much in. Look, I think you should have eggs in different baskets. This is a volatile time. This is an interesting time, but there's also a lot of great opportunities. So why just pick one?
Could not agree more, guys. Aaron Halfacre is the CEO of MODIV. You know what? Let me put the link up on the screen. The link is also in the description. MODIV.com. Aaron, a pleasure to talk to you. The space is endlessly interesting, and good luck. And thanks for coming on All Access today.
Spencer, thanks so much for having us.
All right. That was a lot of real estate. Okay, let's move away from real estate now. As endlessly interesting as it is, and I wasn't BSing. I mean that. The theme of this show is alternative investments. We've talked real estate crowdfunding. We've talked rental homes. We've talked real estate private equity. Let's move away from real estate and let's go private equity. As I mentioned off the top of the show, in case you missed that, this headline in the Wall Street Journal yesterday, literally yesterday, the SEC agrees we need to open up access to private equity to ordinary investors. That's what this next company is doing. And let's play a quick intro video.
Like a lot of entrepreneurs, it was my experience and frustrations as a private venture investor that led me to start Alumni Ventures, with the goal to bring smart, simple venture investing to individuals and family offices. Since closing our first fund in 2015, Alumni Ventures has grown steadily and now has 18 alumni funds, as well as venture funds open to any accredited investor. So what is venture and why might you want to own it? Venture capital is investing in private companies, typically based upon a novel technology or innovative business model that are in startup mode and seeking rapid growth. It's an investment at a point when both risk and reward are high. Simply, venture has outperformed many asset classes over many periods. It's a chance to participate as an owner in new ventures when valuations can be more attractive and potential upside is high. Investing in venture is also investing in tomorrow, in companies that are leaning into the future, working to solve big, hard problems. According to PitchBook's 2020 rankings, Alumni Ventures was the most active U.S. venture firm in angel and early stage investing. Our mission at Alumni Ventures is to make it easy for accredited individuals to create a venture capital portfolio that fits their needs and goals.
All right, let's bring on Luke Antal. He's the Chief Community Officer of Alumni Ventures, and let's get him on here. Luke, thanks for joining us today. How are we doing?
Hey, Spencer. Good. How are you? Thanks for having me.
Did I get tell me you got your last name right, or at least I was close. Antal?
You got it. Yeah,
Luke Antal. Okay. I'm very particular. You can ask anyone here. I'm very particular about names and getting them right. So, and if I get them wrong, just don't. If I got it wrong, just lie, because I'll feel terrible about myself. So, okay, let's talk Alumni Ventures. Tell first. I mean, the video sort of explained it, but tell us what you do, and then we'll get into the nitty gritty. We'll get into the asset class because this is some cool stuff.
Sure. Yeah, no, happy to. And thanks again for having us on. I'm very proud to be here. So I'm a co-founder here, and our company was started back in 2014, and we are bringing the venture capital asset class to to individuals, accredited investors who historically haven't had access to this asset class before. I was just listening to Aaron, and there are a lot of similarities in how we position ourselves. We are unlike a lot of other traditional venture firms, where they are raising money from pensions and endowments and raising funds of $1 billion or more. And we focus on, maybe a short way to describe our customers, our investors we're retail venture capital. So like a heart surgeon in Des Moines is somebody that we think about, somebody who's had a great career and they've made all the right financial decisions, and they've got some extra capital and they want to continue to diversify their own portfolio. And they've never really even had an awareness that they could invest in venture before, because really until us, there was no great way for an individual to do that. And so, our entry points are as little as $25,000 for some of our funds, and you can go, if you want to write a larger check into our funds, you can do that as well. And so, me in my role as Chief Community Officer here at the company, very simply stated, our business can be broken down into raising money and investing money. And my job is to run the raising money side of the house. And so we're sort of a big direct-to-consumer sort of tech firm that happens to sell venture capital portfolios to accredited investors.
So let's talk about those portfolios. So, or maybe let's start with this. I'm an investor. So, like, if I wanted to get started here with Alumni Ventures, what is the process? You said $25,000 minimum, but aside from that, what other things do I need to know? Things that I can't have, need, don't need, and what is the process to actually invest here?
Sure. Yeah. Well, I think for starters, our point of view is that we just try to educate all of the folks who are interested to learn more about us on venture capital, the asset class, and then on our company. And we find that as folks learn more and more about it, they actually become more and more interested. So the asset class and there are materials on our site that sort of go into detail and white papers on this topic and such. But the asset class has traditionally been very, very strong over a long period of time, often almost always outperforming the public markets. Yep. And I heard the previous presenter mention the Yale endowment and college endowments, and ours, we think of the asset class in the same way. We sort of look to the endowments and other large sophisticated investors. They're allocating 10, 15, 20% of their portfolio into venture. And so if you want to come to our site and you just want to get started, I think that we offer a couple of different products. We're called Alumni Ventures because the very foundation of our company is in alumni communities. Our story starts back in 2014 when me and our founder and CEO, Mike Collins, who are both Dartmouth alumni, said to ourselves, wouldn't it be great if we create a venture fund for our fellow Dartmouth alumni to join together and find Dartmouth alumni entrepreneurs to invest in? And the basis of that thesis is that if we build this community of Dartmouth alumni, we are for sure going to be stronger investors working together than any one of us would be on our own. And that's sort of been the status quo for individuals for a long period of time. You hear before us, you sort of hear about a deal about, your nephew's doing something, a juice bar on the beach or something, or you hear about something at the country club. Yep. And that's sort of your deal flow. And we have professionalized that. Our company now, we've got over 150 full-time employees. We've got over 50 full-time venture investors located in 6 different offices around the country. And like the video mentioned, in this short period of time, we've actually become one of the most active venture firms in the entire world. And so I coming back to that foundational root of the alumni base, we took that idea and it turned out to be successful in our Dartmouth alumni community. And we scaled that out, and we now have alumni funds that sort of have that same thesis for 18 different alumni communities. So think all the Ivies, Stanford, MIT, Northwestern, et cetera. That list is available on our site. And that was sort of the story of our company, building that out for many years. We've got some other products too that I'd be happy to share with you.
I want to talk about, you spoke about performance there for a second. I know you probably can't get into like specifics of your investments, but in terms of the overall asset class, I think, can you speak to the outperformance of venture capital? I'm wondering, what is behind this outperformance, if you have any insights there. But we're looking here over the last 25, 15, 10, and 5 years. And VCs, I'm sure there's many reasons for this. It's a complicated thing, but best you can, you give us some insight here?
Yeah, I think that, what is venture capital? Let's start with that. It's making equity investments into companies before they come public. And so, and there's a whole world of a whole range of opportunity in that world. And there are different venture firms that focus on different stages, but in some of them, let's just take one for an example. If you're a pre-seed or a seed stage investor, you're placing a bet on a founder and a company right as they're beginning, right? That's a really long way, oftentimes 5, 10 years, if that company is successful, until it becomes public, which is when it would become available to other investors to invest in and trade on the public markets. So what am I talking about? I'm talking about value creation. And the reason that this graph looks the way it looks is because venture gives investors access to that value creation before the public markets, which oftentimes in the life cycle of a company is many, many years. And that's why the graph sort of looks this way.
Is this because, especially in the last decade or so, companies have just been going public? The ones that do go public are going public so much later in their life cycle. Like a company, like if Amazon, I don't think would have ever made it today, right? Because Amazon went public so early, as opposed to like a company like Uber and Lyft or whomever, right? They're just going public so much later in their lives. Is that a factor here?
It's definitely a factor. Those that do go public are waiting longer, and that's because the industry itself is completely different than it was even a couple of years ago, to be honest. If you look how much venture capital has been deployed into the market even this year compared to 5 years ago, and I don't think we have that graph to show to the audience, but it's an incredibly fast growing industry. So there's just more private capital available to those companies. So yes, that's a contributing factor to your point. If they go public at all, they're waiting longer, but the numbers also are showing that fewer and fewer are going public. And so what does that mean? It means that the value creation is being soaked up by private investors and venture investors.
So let's talk about some of, or I guess like how you source companies, right? What companies that you look for? What are some qualities that these companies have to have that make them a fit for you, which would then theoretically make them a fit for someone like me? Yes.
So we are in venture. There are sort of 2 main types of investors. Let me just set this context. There's a lead investor, and those are venture firms that usually have a stage or sector focus. They find companies, they negotiate the financial terms of the investment, and that takes time, and they're competing with one another. When a founder gets that, it's called a term sheet. When they lock in that term sheet and they choose a lead investor, oftentimes the founder isn't done with the round of financing that they're doing. Let's say there's a 10 million Series A. Oftentimes the lead investor might take 7 million of that Series A. The founder still has to go raise $3 more million. And that's where co-investors come in. And co-investors put money into that same deal on the same financial terms as what the lead investor dictated. Our firm is exclusively a co-investor.
Okay.
And what that does is that it allows us to move more rapidly than lead investors, but not at the expense of high quality diligence. And so what do we look for when we're looking for companies? We are investing across all stages, all sectors, all geographies. And that's rooted in our belief of what's best for our investors. If you're that heart surgeon in Des Moines and it's your first time investing in venture and you want access to the asset class, you want to make sure that you're diversified. You want to have a bit of everything if you can. And so our portfolios, let's say for our alumni funds, are 20 to 30 investments deployed over the course of about a year, and they're diversified by stage, sector, and geography. And so within that, we are looking for signals of who is the lead investor. And there's all kinds of data that we have access to and numbers that we crunch that tell us who are the historically strongest lead investors. That's a signal to us that it's an interesting deal. We take a look at things like, what has this founding team done before? There's a remarkable correlation to success in the startup world on whether or not the founder has done it well before. Are they a serial successful entrepreneur? So we look for that. We look at things like the opportunity of the market size. Is this a potential, what's the potential exit going to look like? How big is this actual market? Is it a 1 million person potential, total addressable market? Is it 100 million? So, venture capital tends to be an asset class where investors really want to swing for the fences and look for those potentially really large outsized gains.
That's pretty broad. It sounds like you're looking for everyone and everything. I guess it's probably the way it should be. I've got up on the screen here. These are a list. I've got your alumni funds, alumni networks are on the left, and you've got some other funds though. There are other ways to get access to Alumni Ventures. It's not just the alumni network, correct?
That's right. I think, well, first off, let me say that we're having this great conversation about 2 weeks too early, because we are launching a brand new website, totally refurbished, completely rebranded in the middle of October. And so if you're listening out there, I'd encourage you to also come back in a couple of weeks. But yes, if you don't happen to be a member of one of the alumni communities that I mentioned earlier, which is actually the majority of the market. So let me just really sort of paint the picture here. There are 10 million accredited investors in the United States, plus or minus. And only 3% of them have ever made a startup or a venture investment before, because the access has basically been inaccessible to this point. And of those 10 million, only about 20% went to the schools listed here and the top 25 or 50 schools. So
20% even seems high.
Right, yeah. And so the ocean of opportunity, we have a great business as it is, just with the alumni funds. And that's what we built from 2014 through really like 2018. And around that time, we said, well, let's build some products for the rest of the market who didn't go to these schools. So I'll start with our Total Access Fund. This is every new investment that our firm makes. And if you remember back to the video, last year were actually the most active venture firm in the US. And so if there ever was an offering for venture capital that did a good job in sort of mimicking the overall market, this Total Access Fund is that product for us. And every quarter, there's about 50 or 75 new venture investments that we make. And that's what the Total Access Fund is. And many new investors who have never made any venture investment before find that this is sort of how they like to dip their toe in. And we also, as you can see here in the middle of your screen share, we've also got a lineup of focus funds. And so right now we're raising a blockchain fund. We are finishing up a deep tech fund. We have an impact fund that's being launched in Q1 that is going to focus on ESG and anti-bias solutions. And so I won't go through, but there'll be 2 per quarter, 8 next year. And each of them has a thematic investment strategy. And this is where our firm becomes a little bit more T-shaped, coming back to your question of how do you find the right deals? And we're in the process of building up a team to supplement our existing team we already have 50 plus full-time venture investors right now. We're building up another team of 10 to 15 new investors that we're recruiting in who come from these specialized verticals that bring with them a career of experience in investing in these specific thematic areas. And so in that way, that deal flow will benefit obviously the focus funds, but it also, because we're all under one umbrella and we all share systems and data and we're all one team, those deals also may find their ways into the portfolios as well.
Okay, so for the focus funds, anti-bias, well, that fund's closed. But okay, so ESG fund, for example, you start with a theme and then you go find the companies. But I'm wondering, like, how much of that initial start is like, oh, like I've observed that there's just a lot of ESG focused startups out there, or like I guess I'm wondering, is it entirely you guys starting with a theme, or is there some sense of we've seen there is supply out there, ample supply, and then we go backwards from there?
Yeah, I think it's a little bit of both.
Okay.
I think one of the unique things about our company is that we are truly sort of network powered venture capital. And so in support of all of these funds, we have over 550,000 people that have signed up to join the Alumni Ventures newsletter, or the email newsletter of one of our funds. And so that community is really the base it's the source of our capital, it's the source of our deal flow. And it leads to things like our expert network, which helps to inform a lot of different things. One of the things is like, where is the puck going in venture capital? And so what I mean by that is like, what are the hottest sectors going to be? And we've used that information to sort of dictate what these focus funds are, what this lineup looks like. And then again, because we're all under one roof, if our 4-person investment team for our Harvard fund at the Yard Ventures, when they source a deal, we have an internal process where they, look at the founder, and let's say and they look at the founding team or what the company is doing, and let's say that it's a great deal for that fund, our Harvard portfolio, but it's also fits the criteria for our impact fund, and it's an ESG deal. They check a box, and we are able to, because we're all using the same systems, we're able to evaluate that deal for both the Harvard fund and as a potential candidate to go into the ESG portfolio, for example. And it doesn't mean that it always does. We've got a very stringent internal process that we use that sort of leverages the wisdom of small crowds and captures data consistently on all of the deals that we look at to help us make informed decisions on how we construct these different portfolios.
So when I hear that, like, I could potentially get access to venture capital, the first thing I think is I have absolutely no experience investing in venture capital, and most individual investors like myself, frankly, have no experience investing in venture capital because it was such a walled off asset class. It has been for its entirety, basically. So, like, what advice do you have for investors that look at, I'm just going to arbitrarily choose, the Princeton Alumni Fund, right? I went to Princeton. I've heard of that company and I want to invest, but maybe they haven't thought about it in depth that much. What advice do you have for these investors who don't have the experience investing in venture capital?
Well, I think that the first decision point is, do I want to add venture capital as an asset class to my portfolio? And the track record of the the asset class, speaks for itself, and it's a decision that's 100% up to an individual to make.
Right.
We think we've got a pretty good strategy to provide returns to our investors. And so if you do decide that venture is something that you want to add, we also think that sort of the way we go about it is a smart way. In other words, like, you don't really need to do the work. We'll do the work for you. And because we're a retail venture firm, we have every different flavor of individual joining in as investors with us. Some folks understand the value of venture and they want to write a check and they want to get back to their life, and that's cool. But we also provide ways for our investors to become much more engaged and to educate themselves and to take next steps to sort of experience that tip of the spear of innovation where we really play and where we spend all of our time. And we do that through a couple different things. I'll talk about two of them very briefly here.
Yeah.
One of them is our venture clubs. Every investor that joins one of our funds gets a free membership into the venture club for that fund. Think of this as an online portal that you can log into, where as an investor, you get access to exclusive content about the fund, the portfolio companies, access to our investment teams, abilities to connect with other investors. And everything in that world is really meant to provide opportunities for our investors to increase their level of education on venture capital and entrepreneurship and whatever the theme of that fund is. The second thing, so those are venture clubs. The second thing are syndications. This is a term that we use to sort of for shorthand to describe the opportunity for our investors to invest in one particular deal. So sometimes when we make an investment in one of our portfolios, we'll negotiate more allocation into that one deal beyond what the fund will make. And we package that extra allocation up and we offer it to individuals, our individual investors, to choose if they want to come in. And that actually happens to be at an even lower minimum at $10,000 through our venture clubs.
Okay.
We provide our investors with all of the diligence materials that we have, private investment committee calls, everything of that nature in a secure data room. And the individual sort of gets to play venture capitalist and review that and decide if they want to opt into that individual deal.
What kind of allocation do you typically see? I've asked this question of everyone today, and not that anyone can truly know the answer. It's up to the individual, right? But like, how do you see investors in Alumni Ventures just allocating?
I think the key here is how do we get into the highly selective deals? Because really that's what venture capital is all about. And so we have sort of made our model, we've designed ourselves to be very flexible in our check size. So sort of very short answer, we can write a check into a deal from anywhere between $50,000 and $10 million. And that's a big range, and it depends. Every situation is different, and but we're there.
Right, but in terms of like how I would invest, right? Do you have any insight there?
Okay, I got you. So our alumni funds have a minimum of 50,000. Our total access fund has a minimum of 50,000. The focus funds have a minimum of 25,000, and each of those individual one-off syndications is a minimum of $10,000 through your venture club. And as you think about it, it's really a personal decision. I think first you got to think of your own. Where's your portfolio at already? How much of that do you think you want to put into venture? How much of that do you want to put in now versus over time? So the other thing is that each of our funds are, offer different vintages. Our alumni funds, they raise and invest every year. And so a lot of our investors think about, okay, I want to allocate X dollars this year, and I'm going to do every year that amount, or every third year. And sort of different people think about it different ways. But then within that slice just for venture, you've got our diversified portfolios, and you've got sort of home run shots into syndications that you can think about too. And, it's a highly personal decision, and, different people think about it different ways.
Last one here, unless the chat has anything else, is, and I guess I don't really even know if there are other firms doing the similar model. Maybe there are, or maybe there aren't. But regardless, in terms of just how you approach venture capital compared to other venture capital firms, for example, what is your number one selling point that you know, when you're going after these companies and you say, this is what sets us, this is what makes us different, right?
Yeah. Yep. Yeah, we are network powered venture capital, and there isn't another firm that really has this model where we bring to bear the power of 550,000 plus community members, 7,000 plus existing investors. We've got a portfolio of 800 plus founders already, and we feel like we're just getting started. So there's a ton of expertise and value that we extract from that community and provide that to our founders through what we call our CEO services, which is sort of a packaged bundle of products that we offer to founders to help them along their way if and when they need that from us.
Luke Antal is the Chief Community Officer of Alumni Ventures. Let's make sure the link is up on the screen, avgfunds.com. It's also in the description of this video. Luke, thanks a lot for coming on today on All Access.
Thank you. I appreciate it.
All right. Guys, that's going to be a wrap for the show today. We're like a minute over, but I don't care. Look, I'm trying, we're trying, okay, to talk not just about the same 20, 30 stocks every day. I've gone on some rants in the past year about what I perceive to be, people being irresponsible. This comes back to being a responsible investor. That's all this comes down to, right? Being a responsible investor. We, Benzinga, are not telling you to invest in any of the companies that present today. We're not even telling you to invest in those asset classes, but we're telling you that you should, at the very least, think about it and learn. At the very least, learn, right? Because that's what I'm trying to not preach here, but that's what, real investors do, right? They don't just own the same 10 hot stocks that everyone owns on Robinhood, right? There's more to the markets than that. There's equities, there's commodities, there's crypto, there's real estate, there's private equity we just talked about, right? I'm not even thinking of the other ones. There's bonds, treasuries, right? There are so many alternative investments. There's an entire world out there. We want to bring them to you because it's important. It's important from an allocation standpoint, from a diversification standpoint. Truly, I genuinely believe that with all my investing heart, from the bottom of my investing heart. This stuff is important, right? This is how you build a true diverse portfolio for the long term. And so you're not just subject to the daily up and downs of whatever the FANG stocks are doing today. There's more to life than that. There's more to investing than that. So that being said, we're going to do this again. I don't know when, but if there's a specific company you want to hear from, not even company, if there's a specific asset class that you want to hear from, you want to learn more about, you don't know anything about it, and you want to learn, and you want us to bring you a company that's in the space, let us know. Email shows@benzinga.com. I think the email is up on the screen. Oh, wait, there it is. Shows@benzinga.com. Okay, tell us what asset classes you want to know about. We're going to do this again, I promise, because this is really important stuff and interesting, right? Come on. I mean, how often do we talk about private equity on this channel or real estate on this channel? Not very often. I don't know what's going on with the screen there. I'm not doing that. Whoever's doing that's doing some weird stuff. So anyway, smash that like button, guys. That's a wrap here. Once again, all the companies that were presenting that came on today's show are partners of Benzinga. That is why the show is demonetized on YouTube. Just get that disclaimer out there. And as always, do your own research. Smash that like button. We will do another one of these again soon. I hope you enjoyed it. I've been looking forward to this one for like 2 or 3 weeks now because it's something that's off the beaten path for us and truly valuable stuff. So thanks to Aaron, thanks to Luke, thanks to Ryan, thanks to Brent and Chris at the top of the show for coming on today. And Power Hour is coming live right now. I got to hop off the stream. I'm rambling way too long. Just too much rambling. I got to stop. I got to stop. Too much rambling. And Power Hour will be live right now. And we'll see you guys. You might see me on there. Maybe. Probably. Maybe.